So I'm a data scientist. What that means is the eye twitches and awkward social behavior will only become more apparent. So I hope I've done well so far because it's all downhill from here. This is as good as it's going to get. I'm also a venture capitalist, and someone told me recently, how did it go? The best way to, or the easiest way to create a fortune, a small fortune in venture capital is to start with a large fortune. Because of course most startups fail, and the idea that you can somehow predict which startup's going to survive or fail is a daunting type of task. So I'm going to talk to you about how we combine data science and venture capital. I'm managing director of a fund based in San Francisco called WRHambrecht Ventures, and we were the first quant venture capital fund, as far as I know, anywhere in the world. And we've done several, lots of investing over the last 8 to 10 years. And I'm really excited for a couple reasons. One is our performance has been great. We're somewhere in the top 1 or 2% of venture capital funds in Silicon Valley based on performance. But what's more interesting, I think, is that I really believe the reason we're doing so well in terms of returns is because we actually use something a lot of venture capitalists don't really like to use, which is math. And it's interesting because if you think of risk management, all the classes you tried to avoid taking in college, when it comes to insurance, the way you quantify and manage risk is with actuaries, with probabilities and statistics. You'd expect, you'd be shocked if an insurance company didn't have any math going on. The way we quantify risk as a hedge fund or on Wall Street, of course, in your superannuation funds, there's people managing risk and they're using math to do that. So it's amazing that, really even since the time of Thomas Edison, there are trillions of dollars every year going into new products, acquisitions, and startups. And nobody's ever really used math as a way of quantifying risk or managing those types of portfolios and assets. And I don't really know why that's the case. It's almost amazing to think that that's even true. But that's very much the way the world works. And when I started doing this research 10 years ago, and I had come out of Intel, and I had worked in a supercomputing business at Intel, and it just seemed to me that we could apply a lot of the same principles, simulations, algorithms, statistics, to look at how markets work and to try to predict things inside of those markets. And back then, they didn't have words like big data, predictive analytics. I just looked like I had 3 heads, and I was some little kid with a laptop talking about math, and sort of the investment directors very, they'd say things like, Thomas, you seem like a nice young man, which is never a sign that the conversation's going well. They say, but you can't quantify innovation. You can't quantify investments in startups. It's very much a gut feel, right? You get a feeling about the business, you get a feeling about the management team, and you invest if that feeling's good, and you don't if it's bad. And then being kind of a geek, I said, okay, well, how often does that work? And they said, well, usually 70, 80, 90% of the investments don't break even. Most funds lose money. But if you're really lucky, 1 or 2 of those will be such a success that it makes up for all the failures. And I remember thinking to myself, well, okay, so let me get this right. You guess based on how you feel that day, and you're wrong 70 to 90% of the time. And they say, yeah, right? And so that's what really got me passionate about this research that we do. And I think it goes much broader than our fund. And what I want to do is encourage each of you to not be allergic to the idea of math when it comes to the world of innovation. In fact, I think it's something we all need to embrace. Now, I don't think you can ever quantify passion. I don't think you can quantify how innovative someone is. But by taking the things that our intuitions are good at and combining them with statistical knowledge and data, we found that you can make empirically better decisions about which startups to fund than just to use either one of those tools in isolation of each other. So rather than go through a whole bunch of data science stuff and algorithm stuff, because 99% of you would leave the room if I started, and my wife doesn't even let me talk about that stuff. In fact, she doesn't even know what I do, and it's been about 10 years. She's like, yeah, when's the check get here? One of them, I want to tell you some things you don't normally hear in a talk about innovation, because we're used to hearing things like persist and have a good idea and, you all know that. So let's just take that off the table for a second and talk about some statistics that might be surprising to some of you. One of the most interesting statistics, at least for me, or certainly the most controversial statistic, is the impact of teams on the founding teams on startup performance. Now, when you ask 9 out of 10 venture capitalists what's the main thing that they look at, they say it's the team. And it's true, and I don't think that's a bad answer, but it is a little like telling an audience that you like puppies, right? It's like everyone likes puppies. Puppies, right? I believe in people. I invest in people. And it's like, yeah, people. But the challenge is, a lot of times if you say, okay, well, what about the team do you look for specifically? And they say, well, we like a team that has a great track record, that's entrepreneurs that have been successful before. And you ask, well, okay, well, is that what you always look for? I mean, did you ever find that not to be the case? And they'll say, oh, yeah, no. I mean, sometimes the best entrepreneurs don't have any track record, but they're the Mark Zuckerbergs, the Bill Gateses of the world, the Steve Jobs had no track, Michael Dell, Larry Ellison, none of these people had track records, but they built the venture capital industry. And you say, okay, so you like it if they have a track record, you like it if they don't have a track record, and they say, yeah, but we also like it if they failed before, because that means they've learned something. And that makes them more wise and savvy, and they have those scars, they don't make those decisions again. So you say, okay, so let me get this straight. You like it if they have failed, you like it if they've survived, and you like it if they've never done this before. Like, well, yeah. And you go, well, it's okay, so what's the rule, right? Who don't you like? Well, I don't know, you can just tell, right? So an interesting thing, when you look at those three categories, a really clever study was done by Josh Lerner and some others in Harvard a few years back. And they looked at those three types of teams. And by the way, there's hundreds of studies on teams and the impact of teams on performance. So don't take my word for it. And there's so many studies now that they've defined teams almost in every conceivable way. Everything from backgrounds to what's their spirit animal to Myers-Briggs. I mean, you name it, it's been done. And they've defined success in every conceivable way. Was it a big exit as a startup? Was it just make a lot of money? Or did they just learn a lot? I mean, anything you can possibly think of. So this one particular study, though, looked at founders who had failed, founders who had succeeded, and first-time entrepreneurs. And all it did is just saw how they did in their next startup. And they tried to figure out, is there any difference in performance? And what's interesting is, actually, the founders who had succeeded before did the best. 30% of them did well in their next startup. The next best group were the ones who had failed before. So 20% of them did well in their next. And the worst performing group were those first-time entrepreneurs. Only 18% of them did well in their next startup. But I want you to listen carefully to what I just said. The best performing group, 30% of them did well. The worst group, 18%. So the difference between the best and the worst was only 12%. So the team, as a variable, because I'm a failed to explain 88% of the variance in outcomes. So it's not that the team doesn't matter. It's that if your job is to predict which startups are going to make it or not, and you're hunting for the right variables, you should never put more than 12% of your decision on the team. And you need to figure out what the other 88% of that equation is. So that's just a way of introducing you, hopefully, to a way of thinking about this problem in a way that you probably haven't thought of before, or it's not the common way of talking about this thing. Let's get specific. Let's talk about the predictive weight of specific variables that can be tested, and you can look for whether or not they're statistically significant. So that's the kind of work that I do, and you have to be a little weird to spend 10, 12 years of your life doing that. But what we found is a lot of the variables most savvy people focus on are really not that predictive of outcomes 7, 10 years later. And there's a lot of other variables that we all know, but we don't really think about too much, that turns out statistically are much more predictive of outcomes. So most folks are looking at the wrong things. And that's the fun thing about this research. And I think it's important research, not just to make people money, but because I think there's a real social issue here. If venture capital funds keep failing 70 to 90% of the time, they're going to attract less money, which means less startups are going to get money. And there's a problem. In fact, less than 0.5% of startups get venture-backed funding in the US. But if we can get better and treat this not just as art, but also as science, we can start to improve the yield. We can start to pick more winners, and we can move the probability and the percentage, the proportion of winners. And that's exciting, because what that means is, yeah, okay, more of our portfolio will succeed. The fund managers will do well. Our investors will do well, which encourages them to give us more money, which gets more money into the hands of those really awesome startups. So it either creates a virtuous cycle or a destructive cycle, and it all depends on how well those asset managers pick. And we all know that even one or two of those startups, like the Googles, like the Facebooks, can completely transform the well-being of an entire economy. Right? One Google would have a bigger effect on Nepal or Kenya than almost all the foreign direct investment and other types of well-intentioned efforts that have been going into countries like that for decades. You know, one Google could probably triple or quadruple the well-being of people in a country like that. So we all have both a social reason and an economic reason to say, hey, wait a second, it's not okay. Nobody wins when good businesses fail, and we have to get better at picking them, which also means when we know what variables to look at, the startups can also try to change their strategies to increase their own odds as well. So I think we all have a lot to benefit from this if we decide we're going to treat it as science, which means stepping on the toes of some of the artists. And I think it's okay, given what's at stake. So it's an idea that we don't have enough time to go into all the details of, but I just wanted to give you an understanding that this kind of work is being done. I started doing this work at Harvard, again, over a decade ago, and we've had a lot of success as funds, and we're seeing other funds start to get the message. And we're seeing a lot of big funds in the US very quietly and very cautiously hiring data scientists and starting to make this part of their program as well. So there was a time when Wall Street was an intuitive art. A lot of people don't know that. I was told this by someone who used to trade in the pits of the New York Stock Exchange, and he said, no, Thomas, it wasn't quantitative like it is now. He said, back then, it was all about sort of reading the other people in the pit, in the trading floor. And I know when Smitty's eye twitches that he's going to sell, so I'm going to, And the idea of using math was alien and insulting, and there was a lot of resistance. And of course now, about 90% of trades are automated, for better or for worse. But I don't think venture capital is going to have the same trajectory as Wall Street. I think it's going to have its own story. And I'm not advocating a world where algorithms pick all your deals. We don't even do that at our fund. But I am saying, let's use the things our brains are good at and combine them with computing power and statistics for the things our brains are bad at, and do a better job in the aggregate. So just to make that point a little more, in the last few seconds, I'm going to do something that I hate deep down in my core, which is audience participation. I know you hate it. I know I hate it. Let's get it on. So if anyone here has a coin, we're going to do this quickly, too. If you have a coin in your pocket, if you don't, you can share, borrow one from your neighbor. Let's all get a coin out. I promise it'll be worth it, mostly worth it. You don't have to give me the coin. You keep your own coins. Actually, anything you can flip. If it's a coaster, if it's your cell phone, don't drop your phone. Anything flippable, take it out. Okay. It's going to be a very, very simple game, okay? And there will be winners and losers, okay? So don't be a loser. What we're going to do is you all do heads and tails in Australia, right? I'm not the only one who, okay, good. The other day I was talking about a Chevy car and everyone gave me blank stares. I asked for a coffee with cream and sugar and the room stopped. I don't know what I said. Someone please tell me. Someone's like, he means a flat white. Yeah, okay. Okay, what we're going to do is you're going to flip your coin on the count of 3, and if you have a head, stand up. If you have a tail, stay seated. Okay, 1, 2, 3, flip. It's okay if it's on the floor, it still counts. If you have a head, please stand up. If you don't, stay seated. Now the heads are among the winners, so they're already separating themselves. Okay, we're going to do this again. On the count of 3, 1, 2, 3, flip. If you're a head, stay seated. If you're a tail, please sit down. Wow. One more time. Flip your coins. 1, 2, 3, flip. Heads, stay standing. Tails, sit down. What the heck? Are like Australian coins not balanced? Okay, last time. Heads, 1, 2, 3, flip. Heads, stay standing. Tails, sit down. Okay, good enough. Now, those of you still standing, the winners, by the way, thank you, winners. Let's give them a quick round of applause. You have beaten everyone else in this room at a game where we all started on the same footing. So I'm just going to ask a few of you still standing, how'd you do it? Okay. Well, let me ask you a question. Are you left-handed or right-handed? Right-handed. Left or right-handed? Right-handed? Okay, we got 3 right-handed. Are you seeing it? I'm seeing something. I think we're onto something. Okay, wait. 2 females and a guy. Right-handed females maybe have an advantage here. Favorite color? Oh, 3 blues! Yes, so, based on this statistical sampling, if you want to be a winner, and not a loser, it would help if you were female, right-handed, and your favorite color is blue. And if you can do those 3 things, maybe in Thailand, for some of us, then you too can win like they do. You can sit down now, by the way. Thanks, winners. Good job. What's wrong with that? Go ahead, let me have it. It seems a little random, right? But think about it, and this is the only point I really want to make, is in business, the way I learned in business school, in all the books in the bookstores, the case studies at Harvard, what do? We look at great companies, and we try to find out what they had in common, right? That is the foundation of how people study innovation and business today. It sounds a lot better when they find, some random author says, oh, all of the, these great companies all had a kind of a green energy. And we're like, oh, green energy, right? Or whatever it is. Oh, they all had amazing supply chains. Well, that sounded smarter. Or, oh, yeah, they all had a passion to win and a long-term vision. Like, oh, yeah. But how do we know if it's good advice or bad? If all they're doing is finding commonalities among companies succeed. And I want to put that bug in your ear because it's a statistical question. The only way we could start to figure out whether or not it matters if you're female, like blue, and right-handed, is if we then look at the failures and see if they too had those qualities. And it's not until we start to balance the things we learn from the successes with the failures that we can actually figure out which advice is worth listening to and which is just opinion. So it's a very big shift because, again, 70 to 90% of businesses fail, but we don't study them. We don't remember them. I mean, it would be hard to list 10 failed businesses. It's not easy. But we could all list 10 successes right away. Every day I hear, oh, well, you got to be like Steve Jobs. You got to just, be kind of an asshole and have it your way. And that's how I'm going to run my company. And you're like, well, maybe. But there's a lot of failed companies run by assholes. So maybe that's not the thing, right? And it takes long. People go, well, yeah, but Thomas, that's really hard to then cancel out, what works and what. And I said, yeah, because this is science, and we can't rely on pseudoscience because that's what we've been doing, and that's how we got to 70 to 90% failure rate. So I've been preachy enough. What I do hope you come away with is, look, there are people that feel passionately that we need to take a more statistical and scientific approach to the way we learn about business. And the reason isn't just so that we can seem a little preachy, but because I really think this is a social issue, just like healthcare, just like political science, just like so many areas, engineering and the other physical sciences. We need to treat this seriously and study it with the same level of rigor if we're going to do better. And that's what we're all here to do. So thank you very much for your time. I'm over my budget, so have a good night.